If you work in finance, or you want to, there is one word you will hear constantly in fixed income markets: duration. Portfolio managers talk about it, risk managers monitor it, regulators require institutions to report it, and if you want to work in institutional finance, at an asset manager, an insurance company, a pension fund, or a bank, understanding duration is not optional. In this video, I am going to explain what duration is, why it matters, and how institutional investors use it every single day to manage billions in fixed income portfolios. Duration has two related but distinct meanings. The first is a measure of time. The second is a measure of price sensitivity. Understanding both is essential. Let's start with the duration as a measure of time. When you buy a bond, you receive cash flows over time, coupons paid periodically, and the face value returned at maturity. Duration measures the weighted average time it takes to receive all these cash flows. Think of it this way. Imagine two bonds, both have a face value of $1,000 and a maturity of 10 years, but the first bond pays a coupon of 8% per year. The second bond pays a coupon of 2% per year. The first bond pays much more cash earlier, $80 per year versus $20 per year. Because you receive a larger proportion of your total return earlier, the weighted average time to receive your cash flows is shorter. The duration of the first bond is lower than the duration of the second bond, even though both mature in 10 years. A zero-coupon bond, which pays nothing until maturity, has a duration equal to its maturity. Because all cash flows arrive at one single point in time, this version of duration is called Macaulay duration, named after the economist Frederick Macaulay, who developed it in 1938. Now let's move to the second and more practically important meaning of duration. Duration as a measure of price sensitivity tells you how much the price of a bond will change when interest rates change. Specifically, modified duration tells you the approximate percentage change in a bond's price for a 1% change in yield. If a bond has a modified duration of 5, a 1% rise in yields will cause the bond's price to fall by approximately 5%. A 1% fall in yields will cause the price to rise by approximately 5%. If a bond has a modified duration of 10, the same 1% change in yields will cause approximately a 10% change in price. This is the version of duration that portfolio managers use every day. When a portfolio manager says the portfolio has a duration of 7, they mean that a 1% rise in yields will cause the portfolio to lose approximately 7% of its value. Why does duration matter so much for institutional investors? The first reason is interest rate risk management. Interest rate risk is the biggest source of risk in most fixed income portfolios. Yields move constantly, driven by central bank decisions, inflation data, economic growth, and market sentiment. A portfolio with high duration is highly sensitive to these movements. A portfolio with low duration is less sensitive. By measuring and controlling duration, institutional investors control how much interest rate risk they are taking. The second reason is liability matching. Institutional investors like pension funds and insurance companies have liabilities with their own duration. A pension fund with long-dated liabilities might have a liability duration of 15 or 20 years. If the assets have a much shorter duration, the portfolio has a duration mismatch. When interest rates fall, the value of the liabilities rises more than the value of the assets. The funding position deteriorates. By matching asset duration to liability duration, institutional investors protect their funding position against interest rate movements. This is the foundation of asset liability management, ALM. The third reason is regulatory requirements. Under Solvency II, insurance companies must calculate their interest rate risk capital requirement based in part on the duration mismatch between assets and liabilities. A larger mismatch means more regulatory capital must be held. Managing duration is therefore directly linked to capital efficiency. Let me give you a concrete example of how this works in practice. A European insurance company has liabilities with a duration of 12 years. The investment mandate requires the portfolio to maintain an asset duration between 11 and 13 years. One morning, the portfolio manager checks the dashboard. The current portfolio duration is 10.8 years, below the lower limit of 11 years. The portfolio is short duration relative to the mandate. This means the portfolio is not adequately protecting the funding position. If interest rates fall, the liabilities will increase in value by more than the assets. The portfolio manager needs to increase duration. They can buy long-dated government bonds, or they can enter into a receive fixed interest rate swap, which increases portfolio duration without requiring a large cash outlay. Every decision starts with duration, not yield, not return. Duration. Duration is not a complex concept, but it is one of the most important tools in institutional fixed income. Once you understand it, you will see fixed income portfolios very differently. If you want to go deeper, how duration is calculated, how convexity complements it, and how institutional investors use derivatives to manage duration precisely, subscribe to this channel. We publish weekly videos on fixed income, ALM, and institutional portfolio management. And if you want a structured learning path from the ground up, check the link in the description.